Καλημέρα σε όλους, καλώς ήρθατε στο Economica. Good morning everybody. Welcome to Economica, a quick update from me in less than 180 seconds. Food for thought. What it means if the Federal Reserve cuts interest rate from 4.33 to 4% or etc. So here we have the great database, Fama French portfolio database. I invite you all to check this website. It's great, but I want to give you some food for thought. And so we see here that the market risk premium in the month of June was 4.86%. Okay, so if we take the market risk premium, let's add up the federal funds rate. Okay, so basically the required market return would be theoretically 9.2%. Okay, but now if we take the same required market return and we subtract 4% if the Federal Reserve cuts interest rate, we see that the RM minus RF is not anymore 4.86, but it's 5.2. So that means that theoretically it's very nuanced. If the Federal Reserve cuts interest rate, the market for the same required return on the stock market for the CAPM model, then the market risk premium expands, becomes higher. So it means that the risk of equity, or the beta of equity, becomes larger. Okay, so the market risk premium, which is what the minimum return on investment any investor should ask for in order to cover for the market risk premium. Okay, so it's the minimum basic investment return that investors should ask. So for the same market return, we see that cutting interest rate expands the market risk premium, and we see here, according to the Frama French website, that in the past 3 months, market risk premium it's 10%, and on a 12-month basis, it's 11%. So it's already quite a large market risk premium. I'm not an expert by any chance, and you should ask to your investment advisor. I'm not suggesting anything to anybody. I'm only sharing with you my thoughts. Is that the cutting interest rate expands the market risk premium, and that basically intrinsically makes investment in stocks more risky. In what sense? That the required rate of return for investing in any equity, it's higher, and so it's larger basically. And so let's make 10.35%. Okay, we add back the federal fund rate, so the total the required market return for a portfolio of 3 months is 14.68%. Now, instead of discounting for 4.33, we discount for 4%, the Fed cut interest rate. The market risk premium from 10.35% expands to 10.68%. So the minimum required rate of returns on an average 3 months basis, it becomes larger, it expands. And so that means that investing in stocks requires a larger return. So that's what I'm saying. And so that means that intrinsically the stock market becomes riskier. There is more moral hazard to take to hold stocks when you need a 3 months return to be more than 10%. Not all stocks can give you on average more than 10% return in a 3 months. So you investors basically risk allocating capital, monetary resources into an investment which does not guarantee the required rate of return. And we have not discounted the rate of return for inflation, which is quite higher in the United States. So that's something to bear in mind. And another thing concerning the federal funds rate, it's very, very easy. If we go and check some ETFs, we see that LQD, which is the bar line here, okay, is compared with some other bond ETF. So the PND, it's all bonds ETF, TLT, it's the treasury bonds, high yield, HYG, AWG, is aggregate bonds. So we see that what it's performing best on a even on a percentage basis, it's LQD, so investment grade corporate bonds. So that means that in the market, there is a higher risk premium for sovereign debt, which can be TLT, which is here. TLT is the worst performing ETF, which tracks the treasury market, treasury securities, which is the United States sovereign debt. And what performs much better, which is here, it's corporate bonds. So that's another nuance in the market to see that, for example, the federal funds rate decides the cost of money for the government, but that benchmark is that actually the true risk-free rate for the economy, or it's something else. Vice versa, is it the corporate rate of borrowing, the real risk-free rate in the economy, rather than the federal funds rate? So that is a theoretical, I don't know, interest rate term premia or interest rate term structure conjecture. In other words, to say, is it the neutral rate, neutral level of interest rate precise when we track the TLT or the treasury yield curve, or otherwise it's more precise to define the neutral level of interest rate with the investment grade corporate bonds yield curve. So that changed the whole ball game, because that means that corporate bonds, they are a safer investment than sovereign debt. Not for a minute or two. But then it's this kind of question or food for thought. It reflects, basically, it reflects the simple construct that the economy does work for what the Federal Reserve decides is the cost of money at the Federal Reserve, or otherwise the real economy works on what is the interest rate, basically monetary transmission mechanism. And so the corporate interest rate in the private sector, which is the corporate bonds, and then all sorts of interest rate in the private sector, are those benchmarks are what define the interest rate level for which we have to discount an investment, or discount, I don't know, consumption, or but basically an investment. So that's the nuance. So there are two things which have been puzzling me, is that basically, not basically, but I think it can be acceptable, the fact that when the Federal Reserve is going to cut interest rate, the market risk premium will expand. So investment in stocks or equities will become riskier. Riskier in the sense that a higher market risk premium or a higher rate of return will be required by investors. Okay, north of 10% or 12%, it depends on the time horizon of the portfolio allocation. Okay, and then you still have to account for inflation. Okay, and then we have another paradox in this market, that corporate investment grade corporate bonds have been performing much better, also in terms of credit spreads, compared to sovereign debt. That's not only a feature of the United States; it is a feature of France or the UK. Some other European countries. I don't have the specific data, so I may be wrong, but definitely it's a feature of the United States. We can see it here. So what is the neutral level of interest rate? Is it really the federal funds rate, or is it something else that includes also the investment grade corporate bonds yields, basically? So that's all for me, and I was hoping to do an update in less than 180 seconds. It's 10 minutes. It doesn't matter, and I'll come back with the larger video, larger content for some ETF and the gold correlation. So I've tried to understand why gold is going so higher. Is this because there is a higher market risk premium in equities, and there is less liquidity? And so basically gold tends to outperform the market with very high volatility when we have a stock market which is not really, there is not much liquidity, or vice versa. So for now, we see the stock market is going higher and higher, and so we presume that there is a lot of liquidity in the market, and then we have situation of distress in markets when we have drawdowns, and then there is a withdrawal of liquidity. What does gold vis-a-vis these two scenarios? But what I've been asking to myself is that, okay, is it gold here skyrocketing because actually it is true that there is a large market risk premium, but are markets really liquid? Or basically investors like large funds or also central banks, they are piling up into gold because they see that the market rally is not sustainable in that sense. So it's a bubble, it's an air pocket bubble, and then there is not real liquidity, and then the market, it can have very sharp short shocks of large drawdowns. And so the counterweight to that market risk, expanding market premium risk, it's gold, which also covers for a very high geopolitical risk. But in case when it comes to the end of time, not even gold is going to save you, basically. So there is a bubble a bit in everything, because if we go for the end of time and the annihilation of mankind on planet Earth, I don't know what you're going to do with gold. if you ever find any gold. So the best thing is definitely that we can have peace and normal civilized cooperation between countries, and because there is always much more that pulls us, that we have in common with each other than divides us. Okay, we progress and we have better standards of living if we cooperate, if we help always when we help each other. That's for all fields of science like medicine, economy, or human resources, or literature and humanistic field of study. Cooperation is the basic requirement for improving the condition and life of all human beings, or of all population, regardless of what is the nation of the country. So I mean, conflict is tremendously useless. It's an horrific thing. So I ask and I wish and I ask strongly for calm and cooperation, even between people who apparently don't like each other, but we have more what unites us, what is in common. We are all human beings, so we need to find a way to cooperate. Okay, so with that, I will come back later after the gym for an expanded content on the ETFs, and I will show you that the most known ETFs which track the market, they are not really what they, those are the most crowded in retail investors, but they don't perform the best. There are a lot of other ETFs that have annual returns of north of 30%. Okay, so we will, I'll see you later. Take care and peace. Okay, just peace. Let's stay peaceful, everybody.